I spoke earlier with Philip Shaw, the chief economist at Investec Securities. I asked him if we're looking at very different responses in the cases of Ireland, Iceland and now Cyprus.
I think we are, but it's also important to realise that the circumstances were very different. Iceland has been recovering fairly moderately for a couple of years, but two of the key reasons why it managed a recovery. Number one, it's not part of the single currency, and one of the key government policies was to let the exchange rate plummet to restore international competitiveness. That's one thing. The second point is that it managed to raise capital controls, firstly to manage the exchange rate, but also to reduce capital flight out of the country. Now, in the case of Ireland, neither of those things was really possible. Firstly, because obviously Ireland's a member of the euro. Secondly, on capital controls, there are 3 points really. Firstly, it's not clear that capital controls are entirely legal under European Union law generally.
Let alone for as long as they've had them and will continue to have them in Iceland.
Absolutely, yeah, that's right. And secondly, Ireland's business model for a while has been inward investment. So if you're going to slap capital controls on international investors, you're very unlikely to get huge inflows of capital for businesses. And thirdly, obviously, it wanted to return to markets to issue its own debt. And of course, if you impose capital controls on investors, that's going to be much more difficult as well. So there are very different circumstances between the two. And one should also point out that in the case of Iceland, it suffered a huge decline in GDP for a couple of years before it began to recover.
And was it 12% it lost in 1 year, wasn't it?
No,
it was over the 2 years, something like that.
Certainly in double digits, and then also double-digit inflation as well. So you have to allow, certainly for the fact that Ireland is a Eurozone country and Iceland had much more flexibility and freedom to pursue a different economic strategy.
Still very, very painful, though, isn't it? If one looks at Iceland, I mean, you're talking about high inflation rates, plummeting GDP, that's really difficult, isn't it? I mean, in social terms.
Well, that's right. I think what Iceland didn't have, and this was certainly part of, if not government policy, then government culture in Iceland, was that it's got a very, very entrenched social model. And because the government balance sheet didn't prop the banks up, you didn't have the degree of austerity which Ireland and indeed other Eurozone countries have had over the last few years. So there was a sharp degree of pain, but it didn't come with the sort of spending cuts and tax increases that you've seen in Ireland in particular.